Hey, what's going on YouTube and welcome back to Tech Conversations. And as always, I'm your host Guillermo. And as always, I'm not a financial expert, no licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So I woke up today pretty happy because I was up about $700 right around when the market opened. And then as you can see, everything went downhill after that. If we actually take a look here, pretty much everything is down today. But anyways, we're not going to get into the reason for why that's happening right now, not in this video anyways, because today I want to talk about call debit spreads, or you might also hear it be referred to as bull call spreads. And as that name suggests, this is a bullish strategy. And what that means is basically you want to be trading call debit spreads when you believe that the price of the stock is going to go up. We'll actually take a look at it and see that and use some examples as well. So uh, now before we begin, remember to smash that like button and subscribe, guys. That would really help out my channel. I invest a lot of time into these topics and explaining them to you guys, and that's all I ask in return. So thank you guys so much for your support. I really appreciate it. And if you haven't checked out my previous videos on spreads, I'll put links to those videos in the description below. Go ahead and check those out as well. And like in those videos, for this video, we're going to be using American Airlines for our demo. Again, this is just picked out at random. There's nothing specific about it. So we're going to go over to trade American Airlines options. And so as the name suggests, right, call debit spreads, we're going to be dealing with calls. And so we're going to be buying a call, and we're also going to be selling a call. Now, remember, when you buy a call, you're hoping that the share price ends up going above the strike price of the call you bought. Now, in contrast to that, when you sell a call, most of the time you're hoping that the share price stays below the strike price of the call you sold, right? And so, again, for this demo, we're going to be using this options profit calculator because it comes in very handy when we're trying to visually see what's happening with our net losses and our net gains on a particular day leading up to the expiration date, depending on what the price of the stock is. Okay, so now before we even get into call debit spreads, it's important that we understand how what buying a call looks like and how that works. And so let's actually just first take a look at that. So here we are. I went to this under basic tab and we went to this long call. Okay, and so we're going to buy a call just to understand what it means to buy a call and how it works. So we're going to go into the symbol. You're going to enter the symbol for whatever stock you're trying to do this with, and you click on get price. It'll show you the price. And then we're going to buy a call. And so we're going to go into this option. We're going to click on this button, select option. And so again, remember, you can choose whatever expiration date you want to. So for this demo, let's just choose July 2nd again, just at random. And so as you can see, the calls are on the left, puts are on the right, but we're dealing with calls. So we're going to go ahead and buy a call. And again, when you buy a call, you're hoping the price of the stock goes up. So I'm just going to choose a random call here. We'll choose the $17 strike price. So I believe that before July 2nd, American Airlines will go above $17 a share. So we'll click on this $1.05 one. So that means for each share, and there's 100 shares in this contract, we're going to pay $1.05. So we're going to end up paying $105. And that's actually going to end up being the most amount of money you can lose, right, is that $105. And so let's actually graph this out just to get a clear visual on what's happening. So let's do that. I'm just going to change the graph range here. I'm just going to add 18 just so you guys can get a little bit more insight. Actually, let me go a little bit higher. Let me go to 22. Okay, there we go. Perfect. So, as you can see, right, this estimated returns section right here gives you valuable information, right? It's really neat. It calculates everything for you. But as you can see, your maximum risk is 105, just like I mentioned before. That's the most amount that you can lose. But look at the maximum return. Infinite on upside. What does that mean? That means theoretically, when you buy a call, you can potentially make an infinite amount of money on it, right? And the way that would work is, let's say American Airlines just shoots up towards infinity, and it just keeps going and going and going. The higher it keeps going up, the more money you keep making and making and making. Now, obviously, that's never going to happen, but theoretically it can. And so you're going to benefit more when it goes up more and more and more. And that's what you actually see on the graph, right? You can see that this is a bullish strategy, and that you would want the price of the stock to go up as high as it can go. Uh, Now, again, the max risk is 105, and that's going to happen if the price of American Airlines falls at 17 or below. And you can actually see this, okay? So we're going to focus only on the expiration column, but it's neat to see, like, if we take a look at days before, let's say we don't want to wait until expiration date, you can get a clear visual as to what the price would need to be on what date to exit it early and still make a profit. But again, we're going to focus just on the expiration column. So as you can see, at 17, you see this 100. That's a percentage. That means you've lost 100%. And the 100% is the 105, right? So you can see once it's 17, you've lost the most that you can lose, which is 105. And no matter how much more down it goes, that's the most you're going to lose, is 105. But again, as you keep going up, you keep making more and more and more and more, and there's just no limit as to how much you can make. Okay, so I hope that makes sense, and I hope you understand how buying a call works. So now let's look at call debit spreads, because let's say, for example, that $105 is just too much risk for you. You can't afford to lose that much. Maybe you can only afford to lose at most $50 or at most $30. Well, this will allow you to do that, right? It'll minimize this risk. But you'll also see that, just the same with the other spreads we've been talking about, it's also going to minimize your maximum return. Okay, so we're going to go to the spread section here now, and we're going to go to call spread. Okay, and so similarly, we're going to enter our symbol. So that's American Airlines. We get the price of it, and so again, this is going to entail us buying a call and selling a call. And so let's buy the exact same call that we used in the previous example, just to keep this simple and just so that you guys can follow along even easier. So again, we're going to go to July 2nd, and we had chosen the $17 strike price one, which is this 105, right? So this is the exact same call we're going to buy as we did in the previous example. But now let's try to minimize this risk, this $105 risk. So we're going to do that by selling a call. And so let's go into select options, okay? And remember, that's what write means. It means sell. And so remember, it has to be the exact same expiration date, which is why it shows up on that same exact expiration date. And now for this, we're going to want to choose a strike price that's higher than the strike price of the call you bought. So let's actually use let's just keep it simple. We'll just use an $18 strike price. And so for this, we're going to get paid 74 cents per share. And since there's 100 shares, we're going to get paid $74. And so what this is going to do is this is going to minimize the amount you have to pay, right? Because you're going to pay 105 to buy the call, but you're going to get paid 74 to sell a call. And so now you're going to pay 31 cents per share. And since there's 100 shares, you're going to pay $31. And that's actually going to end up being the most amount you can lose now, right? So that's pretty cool. Now you're losing, now you can't lose 105. Now the most you can lose is 31. And some people might like that. But let's actually take a look at what happens to our max return now. So if we calculate this, and again, I'm going to go a little bit higher on this at, let's just say 20. So let's take a look at this now. Let's actually start off with looking at this estimated return section. So again, your maximum risk now is $31, right? And that's going to happen if again, I'm not going to look at these, but I'm just going to look at expiration date. If the price of American Airlines does not go above $17, right? Which is the strike price of the call that we bought, right? So if it does not go above 17 on or before expiration date, you're gonna or on the expiration date, you're gonna lose the most amount that you can, which is $31. And that's again what we see here, right? No matter how far below 17 you go, 31 is the most you lose, right? So at 17 or below, you're gonna lose $31. Now, after it starts to go up to 17 here, we can see that you're making money, right? And you're making money, then you're making money, then you're making money. But let's actually take a look at what happens once you hit 18, right? So at 18, we're making money, right? We're 69. But now let's take a look at what happens when we go even higher. 69, 69, 69. Now you can see that the most you can win is $69, right? And that's what it says here. Your max return now is only $69. So you see that your max risk went from 105 to 31. So that's the good part about it. The bad part now is you went from having a maximum return of basically infinity theoretically to now only $69 is the most you can make from this, right? So again, it has its pros, it has its cons, and you you got to weigh out the risk to reward ratio and figure out if this is what's best for you, right? So best possible case scenario here and what you would want to happen is that the price of American airline the price ends up being above the strike price of the call that you sold, right? So if it's if it's 18 or above, you're gonna make the most that you can. Worst possible case scenario is that American Airlines, the price of it falls below the strike price of the call you bought, because at 17 or under, you're losing the most. Now let's take a look at what happens in between, right? So let's say it actually falls in between both of these at 1750, right? So what happens there? Well, you didn't get to the short call, right? So you wouldn't be forced to sell 100 shares. But what's going to happen is it's going to get to 1750, and so what's going to happen is you're going to buy. Well, let's actually not use 1750 since that's not great. Let's use 1740. So let's say it reaches 1740. Well, this expired worthless, right? So 1740, what's going to happen is you're going to end up buying 100 shares at 1740. Or I mean, no, you're going to end up buying 100 shares at $17 per share, which is going to be $1,700. But since the price right now is $1,740, you're going to end up selling it for that price. And so $1,740 minus $1,700, that's $40. But keep in mind, you did pay a $31 fee. So 40 minus 31 is 9, right? And so that's what you'll see here, right? Is that you at 1740, you're going to make $9. And then again, once it hits 18, you've made the most, 69, and as it goes up, that's the most you can make. So I hope that makes sense. Okay, it might be a little confusing at first, but again, I encourage you guys to come into this options profit calculator. Just mess around with it, and until it starts to make sense, right? And again, it's really nice to have a nice visual on this, right? Because let's say I don't want to wait till expiration date, but I want to make at least $20, right? Well, let's say I want to exit by June 23rd. Well, I can be like, well, it has to, the price has to reach at least 1780 for me to make $20, right? And then you can base, do you want to do this off of that or not? So that's very neat. This is very neat to have, and again, check it out. So now let's jump over back to Robinhood and actually show you guys how you would create this debit spread. So again, we're gonna buy a call. So I believe we chose July 2nd for this. And so we're going to buy a call, and we're going to use the $17 strike price. And then we're going to sell a call, again, with the strike price higher than the one we bought. And so we'll use this 18 until you do that. And as you can see, it recognizes this as a call debit spread immediately. And as you can see now, instead of if we were to just buy the call, right, and pay, $93, now we're only going to have to pay $26. But again, the amount that we can potentially make is going to minimize. And so then you can continue, right? And you can decide how many contracts you want. You can try to ask for a higher limit price. Again, most of the time, it needs to be somewhere in the middle for the contract to get filled. And then you can review order. As you can see, we're going to buy to open a call at a $17 strike price. And then we're going to sell to open a call at an $18 strike price. And so then you would submit, and you would successfully have a call debit spread on American Airlines, right? And again, if at any time, the prices of American Airlines changes, you can jump over here, type this in, and, just look at the graph and understand, where the price might be heading, depending on, what day it is and if the share price is changing or not. So I hope that makes sense to you guys. If you guys have any questions, the best way to get a hold of me is through my Discord. I'll put a link to it in the description below. Me and my friends, we post weekly watch lists. We talk about day trading, swing trading, trading options. So feel free to join if you want. Also, if you plan on using Robinhood in the future, feel free to sign up using my referral link in the description below. If you sign up using my link, you will receive one free stock when you sign up, which is free money for you. So go ahead and use that if you'd like. And as always, guys, I hope you enjoyed the video. Let me know what you guys think in the comment section below, and I'll see you guys next time.